Hi, welcome to the channel. I have been uploading series of educational videos to explain the stock market key concepts in an easy to understand manner for beginners as well as experienced investors. Most of the fear around market activities is very common for many of us because we don't understand the real driving force behind the stock market crash and boom. If we understand the strategy behind the market manipulation and how it is executed by big investors, we can align with their actions to become profitable. I'll be revealing market mystery in a simple to understand approach by series of educational videos. You can support the channel by subscribing, share your honest feedback by comments and like and dislike. Let's turn the market mystery into money. In this video, we will look at the effort versus results. How does it impacts the market direction on a daily basis? So this is a longer video. I have made it as in two parts. In the first part, we would discuss about the basics of effort versus result analysis and five different ways to do the analysis, and also look at some examples in part one. And part two, we will have the remaining content. Let's start. Okay, today topic we want to see basically what is the effort versus result. Just to recap what we have studied or what we have seen in last few classes is demand versus supply. What's the cause versus effect and what is the effort versus results. How these three important factors would influence the stock moves, mark down to sideways, again markup, and then the distribution cases. We have seen it how the demand and supply will play. For example, when it is a market goes down, the supply is high and then demand is less. Similarly, when the market moves in sideways, it's between supply and demand, the balance is almost equal. And later, when it's a kind of like the observation happens during the accumulation phase, later once the stocks get absorbed by big smart money people, then the stock is in the strong hands and then stock will ready to move up even when a small demand comes. So this is what we have discussed in terms of demand and supply, how it can impact the different market phases. Also the cause and effect, we have seen it like how long the cause it's built, effect will be longer. So for example, in V bottom that we just discussed, it doesn't have a much cost build because it just downtrend comes down and then uptrend immediately starts. So there is not much accumulation. So the possibility of effect also very less because accumulation is very less. Similar to the double bottom and then the pullback and bear trap. So those are all like short-lived accumulation. So what we are going to see, the major key topic to know how to read the chart and then how to understand the market context by using effort versus results. What is effort is basically the volume, what you see here at the bottom, and what is the result is the because of this volume, what is the price action happened. Those who doesn't know white and red, we call that as a candle, price candle chart. This is came from Japan. This tech before US has a different kind of a notation, but now widely most of the stock market technical analysts use this candles for their study because of the advantage it has it. So this is a simple representation of up candle and the down candle. Up candle is usually when it happens when the price opens at low and then goes and closes the price at top. So when a market open, the price opens low, and then when market closes, it closes at the high price. Normally, that is called a bull day. Similarly, when the bear day stock price opens at high and then it ends at low, it's called a bear candle. The reason why I'm talking about this candle, this is actually the result which is created on a particular day based on the volume which is happened. So what you see here is the same kind of a candle, but open and close price is almost equal. That is called a doji candle. It is like a balanced day. What does it mean in this very simple demand versus supply or effort versus a result? End of the day, when the price opened at a low and then when the price closed at high, the winner of the day is bullish people because they were able to push the price from a low level to a high level. In terms of three factors, what we can apply here is demand versus supply. Not much supply, but high demand. The market order, it allows the price to move from open price to close price in a bull day, which is makes the price to go high. If you apply the same concept over here, here the demand was less, but the supply was more. What happened? The price was opened high, but because of a more supply, there were not turning for to buy the stock, price fallen. This is where we discussed the equilibrium between the price and quantity. What is that been transacted on particular day? So, but the interesting factor here you can see here, the candle size is so close. What does it means here? Demand and supply is well balanced. In terms of the price, equal amount of demand and equal amount of supply. So the price is not taking any direction, either up or down. So this is a indecision day, we call it as. This gives a clear direction for us what would can happen next day. And this candle can give a kind of a direction what can happen on the next day from in terms of negative or in a positive way. But these kind of candles usually will come into the chart 3 4 days of up move. Then this indecision candle will happen. Then the direction will go from up to down. So when I'm saying this, I'm just only talking about a one single day. But what I'm going to cover more today is it's not a one day decides the market context. We need to know multiple days in terms of doing the analysis, comparing and contrasting with what happened in a couple of days back and what would happen in terms of the direction next couple of days. It's purely based on what is the price action. So what we are going to look at it, as I mentioned earlier, we would look multiple scenarios in which combining these candles, like not single candle, but a multiple candle, how does it help us to understand the market context? There are five different ways to do this analysis. First is the individual candlestick analysis. Then there we would only look at a one single candle and what is the volume involved in that. And then we will come to a decision that or that particular day makes a harmony or a divergence. I'll go in detail later. Then subsequent shift analysis is like we would take current candle and look at subsequently what can happen because of this move. Right after this candle, because of today's move, what would you can expect it? So that's a subsequent shift analysis. And then the price movement analysis is basically we can look at the trend in which the market trend, either it is an uptrend or a downtrend. Based on that, what is the relationship happening between the price and as well as the volume? And non-adjacent price movement analysis is like it is not just a one. When I'm talking about a price movement analysis, we are just talking about a one up and one down. But non-adjacent price movement analysis is like multiple up and down. How does the effort and the result would play? So that would give an indication. And support resistance and breakout analysis, like breaking out this particular, this is area called a support. When you draw a line here, horizontal line, that's in a support where the price touches and goes high. Again, it touches and goes high. Similarly, on the top, you have the resistance line. It touches at the top and then goes down. There is an analysis what needs to be done with respect to effort and results. This is the important five concepts which we have to understand when we look at the chart in terms of doing effort versus result. We are going to talk about only individual candlestick analysis for the first part. The wide range candle is the candle which is a long bar. That means the price opened here and then it say it started at $2 and then it closed at $10 for within the scale of a 10. 2 to 10 is, if you consider, is the wide price swing. And the same day, the volume also, say from in a normal average is this, you take it as a 500. And if it is more than 1,500, it is a high volume. So what is actually this means, when this high volume happening, the same way the price also moves in a harmony with the volume. So effort produces the result. Okay, so between the price action and the volume, there is a harmony. When a high volume comes, similarly, I have the result also happening. The price also moves in a wider range candle. That is a harmony. What is the just opposite of this can happen? Because when the low volume comes, your volume reflects the price result also. So here the low volume means low effort, and the price moved also very less. This is a narrow range candle. For example, we in this case we talked the price started 2 to 10. Here the price is just started 2 to 5. Same way volume was, we are discussing about a 500. Here the volume is again a 500. But in the previous case, we are talking about 1,500 as the volume. So this is where you can understand the price action based on the volume, which is like both are harmony in the nature. That in turn us to understand about the market context, there is nothing divergence happening. Divergence in the sense, there is no anticipation of something going wrong with the price action and then the result it is producing. Now let us go to the divergence case, where I have a volume of just 500 here, but you see the price swing happen from 2 to 10. So this is just opposite what we have seen it in the harmony case. What we are seeing here is the low volume can produce higher price movements. But when it is a low volume, it should only produce a narrow range candle. But why it is happening low volume to produce a wide range candle? If you logically think our demand and supply concept here, it is a least resistance shown one direction. That means there is no much supply here. The market is goes so quick for the price to observe that supply. So that means even the low volume, I can produce a high price swing. Okay, so that's the divergence we are seeing it. Let's go to the next case. This is another opposite of what you see here. In the high volume, you would see narrow range candle. So what is happening is 1,500 is the volume, but we are only able to produce a price of 2 to 5. What logically, in terms of a demand and supply, you can map it here. When it is a high supply here, and then the demand also happening in the opposite direction, but the supply is huge. That supply is converted as into high volume. It doesn't allow the price to go up, even though you put this much effort here. The same effort as what you have put it in this high volume harmony case, 1,500, the same effort you are putting it here also. But the result you are not able to make it. In harmony case, the 1,500, we are able to produce the price swing from 2 to 10 or 8. But in a divergence case, the same 1,500 volume, we are not able to make that price move. What does it mean? There is an opposite observation or opposite forces playing here. That is a good indication that some big smart guys or investors are observing your stock on this place on a particular price range. Okay, so this is how we will just interpret the volume in a nutshell. Between a volume and the price, it happens on a single candlestick. Harmony is when price action reflects the volume. Divergence is when price action does not reflect the volume. So this is a simple table. When a high volume you produce a wide range candle, then it's a interpretation is it's a harmony. Nothing is opposite action in place. Both are aligned. Low volume, narrow range candle, so there is a harmony. But when a low volume, wide range candle, there is a least resistant in the one direction. That's a divergence. That is the indication that there is a going to be a change in direction. That means when it is a up is happening, when this particular candle is coming, then we should be alert that market direction is going to be in opposite in a coming days. Then same way, high volume, narrow range candle. There is a lot of effort is spent, but the price they were not able to move up. So that is another divergence case. So high volume with a narrow range candle means that observation in progress. So just I was just explaining here. High volume with a narrow range candle is this is where that we talk about a distribution when we are smart people wants to sell. They do this kind of high volume and narrow range candle. Similar way, when the market is accumulating at the bottom, you can see high volume and then the candles would be in a narrow range. But for clarity purpose to understand this harmony versus a divergence, this is the basics. So then we would have a multiple candles with different volumes, how to look at it. Those and all like we can look at it in the later.
Which one is healthy and which one to avoid?
Okay, so healthy or unhealthy, what you are trying to do it. If you are a trader, you are trying to catch up your trade during a bull. You want to go for a long or you want to go for a short. So based on this context, you have to take a decision,
No, as we are
right?
not traders,
Hmm. For
so
investment,
it's difficult. Yeah. So which one not to get caught?
if you want to sell or a buy, maybe we can take a decision. We are keep watching our market for quite some time, 2 3 weeks. If the people asking me to Santosh suggest me to buy something, but I'm keep telling them that please wait, I'll let you know. What I'm really trying to do here is I'm looking at this volume and then the candle and see is that the right time to enter, right? So when I should enter is basically. Right. So here I don't see any proper indication for me to buy. Okay. But when I'm going to do a shorting, I will enter in this candle because there is an opposite reaction. I will know that the price will fall down in next few days. So I will do a shorting here. So you will see a more such use cases in when we move to the next type of analysis. But it is very well possible to take a decision to enter or exit a market by this analysis. We will get when we finish this 5 of the analysis, you will get a more clarity how to do that exactly. Subsequent shift analysis. What we have done in the last type is we were just looking at a one candle and then what is the volume here. But in this case, our analysis of a price action is right after a specific candlestick. So when you see a high volume and then the wide range candle, thereafter, it has been considered that the price will go up. That means this indication that high volume with a wide range candle, what happens in next consecutive days is a harmonic subsequent shift. So high volume, a wide range candle is basically we are looking at the very high volume and then the price action also vary. For your question, should I enter now? Yes, you should enter because it given an indication that the future price action will go up due to the harmonic subsequent shift. The next few candles will be a positive one. The price goes up. It's supported by the volume, what you see here. And then the price also harmony with the volume. The next candle will give an indication it is going up. Similarly, what you see here is a divergent subsequent shift. When you see here the high volume and the next subsequent candle falls, say, assume you got this candle and then this candle as a positive candle, it's a good indication that third candle would be a positive when we are applying the harmonic subsequent shift. But after this high volume and then the wide range candle, next day, if a red candle falls, that divergent happening here, because this is not supporting the price it is going. And one other thing you can see that the high volume wide range candle, the place where it is happening in the beginning of the trend that supports the subsequent shift to go up the price. But when it is happening top of the trend, that is the shift is to go down. This is the difference. How do we take a context here? Exactly, we look at the place this candle is happening. Is the beginning of a trend with a high volume? That is an indication that the price move will go up. Or it is happening at the top. Then there is a possibility that supply is coming, or higher the demand is coming, the huge volume play happening, that's going to change the direction. So that's a analysis of a price action right after a specific candlestick. After the candlestick, we are looking at what is going to happen. But in the previous case, we are just looking at a one single candle, and then what is the volume between that candle and what is the price action. So third one is basically we are going to talk about a price movement analysis. Okay, when an uptrend happens, the volume on a daily basis should keep going up when it reaches the top. And then when it is going down, say this is a 10 consecutive days, the 7 consecutive days or a 7 consecutive days, the price on every day is going up the same way volume also going up. So that means that when it is an impulse move, when it is an uptrend, volume supports that uptrend. But when it is coming down, it is also coming down. This is a harmony. This is an indication that a healthy uptrend started. But look at here. Same thing applies in the reverse order. When I'm coming down, if it is a good downtrend to be predicted, when the price going down, when it touches the lower low, at the day, the volume also should very high. And then when it is goes up, it is in the reverse order. This is the harmony is happening in between. It's a price action supports the direction of the market. So like the price goes high, volume also goes high, so things are harmony. But when the price goes high, volume goes down. This is a divergence. How this can happen? If you logically apply, when the price going up without the supporting the proper volume, that means here the weak hands are playing here. There is no strong hands coming into the picture. But in this case, every time volume goes up, similarly price also going up. So the proper amount of buy and effort is happening and the result is happening. But the effort versus the result, it's a divergence here. It is a clear indication when at the top, it is going to reverse. You see here the divergence. Again, it is happening when it is going down, the price is going up. It's a pure divergence. So that's a price movement analysis. So the price movement is in the direction of the trend, should display in increased volume. Price movement is in the direction of the trend, shows a decrease in volume. We will look at the chart. So let's take a very simple example. Let's apply this 3 now. But you see here in this chart, what you see here is a very high volume. And then the price also happening with a very high. So this is a single candlestick we are looking at it. Single candlestick means single day, and a high volume produced a high result in the price. Price moved from 70 somewhere around 75 to somewhere around 100. So volume also high, the price also went high. That means it is a harmony day. When it is not harmony, we have to find out another candle. Let us go here. You see here, the price went down. The price bar is like, it's a very small price change. It's between 60 or somewhere around very small, but you see the volume. the so high volume, it is very much equal to what you see here, right? But the price action is very less. This is a divergence on a single day. So after this, exactly, you see, after this divergence, the price started moving up. When you see the harmony with the price and volume, it supported the further trend to go up. But when it is a divergence is seen exactly on that particular day, when the volume is so high, but the price is so much less in terms of its delta increased, that reversed the direction from downtrend to an uptrend. Okay, so this is a single candle we are looking at in terms of how it can play versus effort versus a result and how it influences the market direction. Let us take a subsequent shift analysis. I'm just looking at the candle. What happens with the subsequent? Okay, let us look at here some candle where we can decide. Let's look at this candle. This is a normal, then this is a normal volume. You see at the dotted lines here, that's a normal volume. And then you see this bar. This is a high volume candle, this one. And you see subsequently also, when it is a normal price range is a small here. Adjacent candles were a very small in size in terms of the price action. But when I have a high volume, the same way price also happening in the high swing here from the low to high. Keep watching my videos by subscribing it. Please leave your feedback by like or dislike and with a comment. Thank you, and let's be connected in future videos.